Stablecoins are no longer just crypto tools. They've become the invisible backbone of digital money. But now a new chapter is starting. The rise of institutional stablecoins, USDC, PYUSD, and RLUSD. All three are pegged to the US dollar. All claim transparency and compliance, but their missions are very different. So what exactly sets them apart? And how do they fit into the next phase of global finance? Let's start with the basics. A stablecoin is a digital token designed to maintain a one-to-one value with a fiat currency, usually the US dollar. In practice, that means if one token equals $1, users can move value across the world instantly, without banks, without borders, without waiting days for settlement. That's why stablecoins exploded in popularity. They combined the speed of crypto with the stability of fiat. Today, over $160 billion worth of stablecoins circulate on public blockchains, and that number keeps growing. But the story is shifting. The early stablecoins, like Tether's USDT and Circle's USDC, were built by crypto companies. Now, the next wave is being launched by fintech giants and regulated financial institutions. PayPal has its own stablecoin, PYUSD. Ripple is entering the market with RLUSD, and USDC, once niche, is now integrated with banks, fintechs, and payment networks around the world. The battle is no longer about crypto adoption. It's about who builds the global settlement standard. Let's break them down one by one. USDC is the pioneer of the regulated stablecoin model. Issued by Circle and governed through the Center Consortium, it's fully backed by short-term U.S. treasuries and cash held in U.S. banks. Circle publishes daily reserve reports and monthly attestations by auditors. USDC trades on almost every major blockchain: Ethereum, Solana, Avalanche, Polygon, Base, and more. It's not just a token, it's infrastructure. Circle positions USDC as a bridge between traditional finance and open networks, and its partnerships prove it. Visa uses USDC for cross-border settlements, Stripe supports USDC payouts, and Coinbase integrates it directly into its products. In many ways, USDC has become the institutional default for on-chain dollars. Now let's move to PYUSD, PayPal's stablecoin. It's issued by Paxos, the same company that once managed Binance USD. Unlike USDC, PYUSD lives primarily on Ethereum and is deeply integrated into PayPal's ecosystem: Venmo, PayPal app, and soon, merchant payments. Its goal isn't DeFi liquidity, it's user experience. PayPal wants its 400 million users to send and receive digital dollars without ever realizing they're using blockchain. Under the hood, PYUSD brings compliance, brand trust, and direct fiat on-ramps. It's the consumer stablecoin, built for everyday payments and retail integration. Then comes RLUSD, Ripple's upcoming stablecoin. At first glance, it's another USD-backed token, but its strategy is entirely different. Ripple isn't targeting retail, it's targeting banks and institutional liquidity providers. RLUSD will be issued on both XRP Ledger and Ethereum, fully backed by US dollar deposits and short-term treasuries, with transparent attestation reports. But the purpose is clear: to complete Ripple's payment network. For years, RippleNet and on-demand liquidity have connected banks using XRP as a bridge asset. Now RLUSD adds a compliant, stable settlement layer that can plug directly into those systems. Think of it as the missing puzzle piece between CBDCs, banks, and stablecoin networks. So how do these three compare in design and intent? USDC aims for universal utility, a regulated stablecoin that can work anywhere: DeFi, fintech, or banking. PYUSD focuses on consumer adoption, making digital dollars usable in everyday commerce. RLUSD focuses on institutional settlement, bridging banks, payment corridors, and on-chain liquidity providers. Different lanes, same highway. But what makes institutional stablecoins so important right now? Because the world is rebuilding its payment infrastructure around programmable money. Central banks are testing CBDCs. Commercial banks are tokenizing deposits. Fintechs are embedding stablecoins under their apps. And all of them need a neutral, interoperable unit of value that can move across networks. That's what stablecoins provide, and that's why their design matters. The next phase isn't about who's faster or cheaper. It's about trust architecture. Who holds the reserves? Where are they stored? How transparent are they? Can regulators audit them in real time? These questions will decide which stablecoins survive institutional adoption. Let's talk about risk. Every stablecoin model has trade-offs. USDT dominates liquidity, but lacks full transparency. USDC is highly transparent, but tied to US banking jurisdiction. PYUSD is compliant, but centralized under PayPal's control. RLUSD will likely offer strong compliance, but limited retail accessibility. There's no perfect model, only different balances between openness, regulation, and trust. But here's the big shift. Stablecoins are becoming monetary infrastructure, not speculative assets. When Visa settles transactions in USDC or PayPal moves money through PYUSD, it's no longer crypto, it's digital cash. And when Ripple connects RLUSD to CBDC corridors and BIS networks, stablecoins become part of global monetary plumbing. So, what happens next? Expect interoperability wars. Each issuer wants its stablecoin to be the standard unit across chains, payment networks, and banking systems. Circle is building Cross-Chain Transfer Protocol, CCTP, to move USDC natively across blockchains. PayPal is expanding PYUSD into Venmo and merchant checkout flows. Ripple is aligning RLUSD with institutional corridors through the XRP ledger and on-demand liquidity. The competition isn't about hype, it's about who defines the new dollar standard for the internet. Now, here's how to analyze which stablecoins actually matter. Use a simple framework, 3 lenses: reserves, reach, and roll. Reserves. Are they fully backed and independently verified? Transparency isn't marketing, it's survival. Reach. Where can the token actually move? Multi-chain support, exchange listings, and integrations define real liquidity. Roll. Who uses it and for what purpose? Retail payments, institutional settlement, or DeFi liquidity. Each shapes demand differently. If a stablecoin scores high on all 3, it's not just a token, it's digital infrastructure. Let's zoom out for perspective. Stablecoins already settle more value annually than PayPal, Visa, and MasterCard combined. They've quietly become the fastest growing form of private money in history. And now, the world's biggest financial and tech companies are joining in, bringing regulation, brand trust, and scale. So will institutional stablecoins replace decentralized ones? Not entirely. They'll coexist. Decentralized stablecoins like DAI or GHO will serve the open DeFi economy. Institutional ones like USDC, PYUSD, and RLUSD will handle compliant, large-scale payments. Together, they'll form a 2-layer stablecoin economy. Open liquidity on top, regulated settlement underneath. In the end, the question isn't which stablecoin wins. It's whether this new system can stay open while becoming institutional. Because if crypto taught us anything, it's that innovation only matters if it stays accessible. This is not financial advice. It's a framework to understand how the digital dollar is evolving and why the real stablecoin competition isn't about price or speed, but about trust, transparency, and global reach.